We are currently sleepwalking towards a supply cliff that is mathematically guaranteed to hit us by 2026. The government tells you they are building 1.2 million homes. The ABS data tells us we are approving fewer homes today than we did in the 1980s. So what happens when you have record migration, record low construction, and interest rates that are about to drop? We don't get a crash. We get an explosion. In this video, I'm going to show you exactly what the market will look like in 2026. I'm going to break down the specific suburbs in Sydney, Melbourne, and Brisbane that are set to double in value over the next decade. And I'm going to give you the strategy you need to survive the great Australian housing shortage. G'day guys, welcome back to the channel. If you're new here, my name is Your Name, and we use data not hype to forecast the Australian property market. Today is a deep dive. I want you to put your phone on silent, maybe grab a coffee, because we are going to go through the numbers that the mainstream media is ignoring. You see, most people are focused on what happened last month. Did prices go up 0.2%? Who cares? Real wealth is made by looking 2, 3, 5 years into the future. And when we look at 2026, the data is screaming one thing: scarcity. We are going to cover the construction apocalypse, the interest rate pivot, and then we are going to go state by state to find the hidden gems that are still affordable today but won't be in 2 years' time. Let's start with the macro picture. It's simple supply and demand, but the scale of the imbalance is unprecedented. Last year, Australia added over 600,000 people to its population. That is roughly the population of the entire Gold Coast, added in a single year. Now, the average household size in Australia is about 2.5 people. So, simple math, 600,000 people divided by 2.5 means we needed to build 240,000 new homes just to stand still. Did we build 240,000 homes? No. We completed around 160,000. That means in 1 year alone, we accumulated a deficit of 80,000 homes. And that is on top of the deficit from the year before, and the year before that. This is the supply cliff. We are adding people faster than we can pour concrete. And it takes roughly 2 years for a high-rise apartment building to go from approval to completion. So even if we started building like crazy today, which we aren't, the supply wouldn't hit the market until 2026. The cake is already baked. The shortage for 2026 is locked in. But wait, it gets worse. Why aren't we building? Why aren't developers rushing in to fill this demand? Because they can't afford to. Since the pandemic, the cost of construction materials has risen by 30% to 40%. Labor costs have skyrocketed. We have a shortage of tradespeople because they are all working on government infrastructure projects, building tunnels and train lines instead of houses. This has led to a record number of builder insolvencies. If a builder signed a fixed price contract with you in 2021, and the price of timber doubled in 2022, they lost money on that build. Do that 100 times, and they go bankrupt. So developers are sitting on their hands. They have land, they have permits, but they are not building because the feasibility doesn't stack up. This is the profitless boom. High prices, high demand, but no profit for the people who actually build the things. Now, let's layer on the third factor: interest rates. We have likely seen the peak of the interest rate cycle. The Reserve Bank has held rates steady to crush inflation, and the economy is slowing down. The next move is down. Whether the first cut happens in late 2024 or early 2025 doesn't really matter. What matters is the direction. When rates drop, borrowing capacity rises. For every 1% drop in interest rates, a buyer's borrowing power increases by roughly 10%. Think about that. Right now, buyers are constrained. They are stress tested at 9%. But in 2026, if rates are 1.5% lower, that same buyer who can only borrow $800,000 today will be able to borrow nearly $950,000. That is $150,000 of extra firepower entering the market for every single participant. When you combine increased borrowing power with the supply shortage we just talked about, you get a recipe for aggressive price growth. Let's get into the specifics. Where do you put your money? Sydney is becoming a global fortress city, like London or New York. The median house price is already around $1.6 million. If you own a house within 10 km of the CBD, sit tight. You are sitting on a gold mine that will likely never lose value. But for investors or buyers trying to get in, you need to look west. The game changer is the Sydney Metro West. I am looking closely at suburbs like St. Mary's. It's the interchange for the new Western Sydney Airport Metro. You can still buy houses there for under $1 million. By 2026, when that airport is nearing completion, the connectivity will fundamentally change the value of that land. Also, keep an eye on Lakemba and Wiley Park. These were traditionally undervalued, lower socio-economic areas. But they are 15 km from the city and have train stations. As the inner west becomes impossible to afford, the gentrification wave is pushing steadily outwards. It happened in Marrickville, it happened in Dulwich Hill, and it will happen there. Now, let's talk about the most controversial market in Australia right now, Melbourne. Melbourne has been beaten down. Land taxes are up, investors are selling, and sentiment is low. Everyone hates Melbourne right now. And that is exactly why you should be looking at it. Historically, the price gap between Sydney and Melbourne is about 20%. Right now, it's closer to 40% or 50%. That is an anomaly. It will not last. Melbourne is projected to become Australia's largest city by population by 2030. You cannot have the largest city in the country trading at a massive discount forever. My picks? Frankston. People joke about Frangers, but look at the data. It's Bayside living for a fraction of the cost of Brighton. It has a train line, a hospital, a university, and a beach. It is gentrifying rapidly. I also like the Sunshine Corridor in the west. It's set to become the CBD of the west with the airport rail link, eventually, and massive infrastructure spend. The stigma is fading, but the prices are still reasonable. Brisbane is no longer the little brother. It is a new world city in the making. We have a runway of growth leading all the way to the 2032 Olympics. The days of cheap houses in Brisbane are gone. But there is still value if you know where to look. I am bullish on the Logan Council area, specifically suburbs like Slacks Creek and Meadowbrook. You have massive logistics hubs creating jobs, and you are smack bang in the middle of Brisbane and the Gold Coast. To the north, Petrie is a standout. It has the new university campus, USC. University precincts always outperform in the long run because they create a constant demand for rental accommodation and local services. And don't ignore Ipswich. It is the last bastion of affordability in southeast Queensland. Suburbs like Goodna and Redbank Plains are seeing huge capital growth simply because people have been priced out of Brisbane entirely. Perth has been the star performer of 2023 and 2024, with growth of over 20%. It is the tightest rental market in the country. But a word of warning, Perth is historically volatile. It is linked to the mining sector. Right now, the fundamentals are incredible: low supply, high incomes. But if China sneezes, WA catches a cold. If you are buying in Perth, focus on owner-occupier appeal. Suburbs like Rockingham and Armidale have had massive runs, but be careful buying at the absolute peak of a hype cycle. Look for established coastal suburbs that have scarce land. Adelaide has been the slow and steady tortoise that beat the hare. It is no longer cheap, but it is stable. The northern corridor around Elizabeth and Playford has seen prices double in 5 years. Why? Because it was the only place you could buy a house for $300K. Now it's $600K. The yield is still there, but the easy capital gains have been made. We need to talk about the rental market because it drives the sales market. Vacancy rates are effectively zero in many parts of the country. This is a humanitarian disaster, but as an investor or property watcher, you need to understand the economic implication. Rents will keep rising. They have to. There is no supply coming. This means yields are improving. For a long time, Sydney and Melbourne were low-yield markets, 2% or 3%, we are seeing that creep up. High rents do two things. They attract investors back into the market, increasing competition for buying. They force tenants to desperate measures, either sharing houses, increasing density, or doing everything they can to buy their first home to escape the rental trap. This creates a floor under property prices. Prices cannot crash when you have people fighting tooth and nail just to put a roof over their heads. So, what is the action plan? How do you play this market leading into 2026? Strategy 1: the ugly duckling play. In a high construction cost environment, established houses are undervalued compared to new builds. A renovation that costs $100,000 today might add $50,000 in value, so don't flip. Buy the ugly house on the good block of land and hold it. You are buying the land, which is scarce, and getting the house for free. Strategy 2: follow the infrastructure. The government is spending billions on metros, highways, and hospitals to catch up with population growth. Find the map of where the new stations are going. Buy within 1 kilometre of those stations before the ribbon is cut. The announcement bump has happened, but the completion bump is yet to come in places like St. Mary's or Sunshine. Strategy 3: don't wait for the rate cut. This is the most important one. If you wait until the RBA announces a 0.25% cut, you will be buying alongside 100,000 other people who read the same headline. The smart money buys when sentiment is uncertain, not when it is euphoric. If you can afford the repayments now, buying before the pivot secures your price. The Australian property market is not a casino. It is a long-term vehicle for wealth preservation. 2026 is going to be a year of headlines about shortage, crisis, and booming prices. You have the data now. You can see the train coming down the tracks. Don't be the person in 2026 saying, "I wish I bought back in 2024 when everyone was worried about interest rates." Be the person who took action. If you got value out of this deep dive, please hit that subscribe button. It helps the channel hugely and ensures you don't miss the next update where we will break down the lending changes coming from API. Click this video here to see my top picks for suburbs under $700,000 right now. Thanks for watching, and I'll see you in the next one.